Okay, it is Joel Olson coming out with another variable rate update today. I want to really talk about three particular things. The first thing is that understanding the Fed, which is the Bank of Canada, or not the Bank of Canada, the Federal Bank of the United States, the Bank of Canada, which is obviously our federal or central bank here in Canada, are not the same. Now, they probably follow the same direction of rates, but rates influence different things in each country. And it actually would be better if I followed the UK or Australia. They have more similar systems to Canada, the United States. Now, as a general rule of thumb, and do not completely put all faith in this, is that you're looking at a 2-to-1 ratio on how hard the Fed needs to raise rates over how high the Bank of Canada needs to raise rates. So, for example, theoretically, if the Bank of Canada raised rates or the Fed raised rates by 2%, the Bank of Canada really could offset that with 1%. And that's just the different things that are happening. Now, last week, big changes as far as huge swings on the Dow Jones, the inflation data, and a lot of things coming out showing inflation is cooling, and a lot of unexpected news caused some big jumps in the stock market and some good feelings that the rate cycle again really coming to a close, and we're seeing sentiment around that, and I think that is meaningful. So I wanted to first address that. Second thing I wanted to address, so this is probably the most worrisome thing that I get this year, is that I'm thinking about a client conversation I had earlier in the year where their friend was talking about rates hitting 5 and 6%. And I admit I was a little dismissive of it and thought we wouldn't really be around that range, and certainly that's where we are. And I'm sure that client thinks like, oh my gosh, my friend really has hit the nail on the head. Now, I don't mean to say that her friend is a moron or anything like that, because that's not the case. I don't really know the context on when he gave their information. But what I am worried about is that statistically a variable outperforms the fixed rate 90% of the time. It's 90-52. A lot of world has happened then. We're talking the Cold War has happened. We're talking the economic activity of the 80s, the financial crisis. Like, we're not talking a small amount of world financial events that have happened in those interms, and the variable still outperform the fixed rate. And so I tend to choose and pick my financial decisions based on historically what is the smartest decision. And just because I get lucky one time, I mean, a lot of people are basing the idea of locking into a fixed rate, no more than, hey, look, I went to the casino and I used the slot machines, but this time I actually hit the jackpot. That doesn't mean that doesn't change the fact that statistically, the more you gamble, the more money you lose. It doesn't change that reality. And so I think that you have to remember, even a lot of people that would predict rates at being so high are people that always predict rates at being so high, that always predict a enormous economic collapse based on high interest rates by central banks. They always predict those things, and so they predict those things for 10 years. So 1 in 10 years, 10% of the time they get right. And I just think it's very dangerous to all of a sudden put some credibility in that. And when statistically we still have a lot of proof saying that variable is better than the fixed rate. And I think you can really look at that there's nothing new underneath the sun in some respects, and you can still really base a lot of financial things as happening that are similar to other times. So that's the thing that way. The third thing I want to touch base on is I think when we talk about the Bank of Canada being fully independent, I don't think that's true. I think there is absolutely political influence. The Bank of Canada governor in the midst of the financial crisis was Mark Carney, who was widely predicted to be possibly the leader of the Liberal Party at some point. And so I think it's not true that they are not politically influenced. Now, there's a whole lot of things we could say about that, but one thing that we also could really consider at this point is that the election cycles. In the United States, they just had the midterms last week, but we do see a few statistics. Almost without exception, the stock market roars for 6 months after a midterm. So, almost without exception. And I say that because in both the Canada and the United States, this year we've been in a situation where there isn't, we are far enough away from changing both U.S. President and Canadian Prime Ministers based on, when the election cycle's on, that it's certainly possible that the idea that keeping rates high, if it was really felt that that was beneficial to the economy, that they could do that with less repercussions. And so as we go into the next slice of Biden's term, and even arguably whether or not here in Canada, we have a minority government. The NDP leader has come out this week saying that that rates are being risen because of corporate greed, and so obviously a ton of pressure beyond that. I think that there could be some meaningful pivot from the political perspective. I would argue that every single bank change this year, for the most part, has been a result of political pressure on the Bank of Canada. And so we could argue that for the sake of making people feel good and to garner votes, that you could see some rate influence on that from that perspective. That's really just a pie in the sky thought, but something I'm really percolating on this week. Anyway, hopefully that's helpful for you. If you have any questions on your variable rate mortgage, can you reach out to us? We'd love to help you. Please do share this video with friends. We'd love to give them a hand with their mortgage. And as always, please subscribe to our channel. It would really help us out as well. Have a great week.